Today we're going to be presenting on Pacific and Western on the verge of a crisis. Today we're going to take you through two crisis situations and how it would impact Pacific and Western. I'm just going to briefly go through an agenda for you. We're going to first review the company's SWOT analysis and the regulatory environment they're currently facing. And then we're going to go into the two situations independently and discuss the options, criteria and analysis, the recommendation we're going to make, and the implementation plan. And then we'd be happy to answer any questions you may have. I'm going to turn it over to my colleague Svetlana. She's going to start going through the SWOT analysis for you.
Thank you, Namita. Dear board, we're here today to present you the crises. And first of all, we have done SWOT analysis for the company in the light of the crisis. So first of all, looking at the SWOT analysis, we believe that in terms of internal factors that affect you, your major strength in the light of crisis are your liquidity, high liquidity, and your entrepreneurship focus. You have very good product right now, credit card, that we believe will strengthen your situation when you're facing the crisis. However, there is one important weakness that we believe may affect you negatively in the light of the crisis. And this is that you have 7 key brokers that provide the majority of deposit gathering activities for you. Looking at the outside environment, external factors, opportunities and threats, and you see the major ones are highlighted in bold. Again, the very good opportunity is the fact that you have new products, this Visa card and mortgages, and also a very good opportunity for you is that you are growing your current businesses in Ontario, the businesses in infrastructure, and also a very good opportunity is to expand your markets further geographically into the west-north Canada. In the light of crisis again, we believe that some of the threats may have negative impact on you, and these are that the cost of borrowing is growing for you, which is general market trend right now, and also you will be facing potential competition from larger banks. In terms of regulatory environment, we would like to draw your attention to 2 key ratios that you see here, but this is the situation before the crisis. So before the crisis, you are doing very well on the 2 of them. Tier 1 risk-based capital ratio that you should keep above the level of 7%, and you are doing very well on this one. You had it almost 9% in the 3rd quarter of 2008. And the second one, total risk-based capital ratio, that you should keep above 8%, and you did a great job on this one too. So now I'm going to pass to leave floor to my colleague Mazier, and he will introduce you the first crisis.
Thank you, Svetlana, for the appraisal of the current situation. Members of the board, we are indeed facing a crisis at the moment, and what seemed to be our strength has now turned into a weakness. Liquidity seems to be a problem, and now that one of our key brokers doesn't seem to be able to do funding for us anymore. So I'd like to start off by taking a look at what kind of impact that might have on our business. When we looked at our deposits, we realized that 203 million of deposits will be cashed out over the next 3 months. Another 889 deposits will be cashing out over the next 12 months. Now, what does that mean for us, given that we have 7 brokers? Assuming that we want to maintain the levels of deposits where they are currently, and assume that each depositor contributes equally to our levels of deposits, we're going to be looking at a shortfall over the next 3 months of 20 million. And over the next year of 129 million. So, to do this, we've considered a couple of options, some of which are long-term, some of which are short-term, to address this. Option 1 would be along the lines of increasing the rate at which we pay our deposits, increasing slightly how much we pay our brokers to incentivize them to sell our product, and in the final analysis, if we have to, borrowing from the Central Bank of Canada. The second option is if we can't really find another brokerage firm to help us, maybe a strategic partner with another a bank in Canada who would work with our overall strategic plans, maybe of moving over to the west of the country. Each of these options have various strengths and weaknesses. Some of them can be enacted very quickly. Some of them might take a lot more time and a lot more resources. One thing we'd like to note is that increasing in rates on our deposits will have a long-term effect because they'll be locked in. Although we know that as time goes on, in the current environment, the interest-bearing loans that we give out will be better and better, so we can afford to do so. So, what are our recommendations to you? We would like to increase by 5 basis points at the rate at which we incentivize our brokers. We want to do this with only 1 or 2 key brokers so that we can raise about $10 million extra in terms of capital, and we want to take $10 million out of our cash reserves. Why are we going this way? We don't believe that we should increase interest rates on our deposits as they're going to be guaranteed for a long period of time, and there's no reason to increase costs for the entire period. We believe that we only need $10 million and we can get that quickly by doing it this way. At the same time, we're going to have to find a new broker. We're going to have to devote the human capital necessary or even bring in the human capital necessary to go and find that. Over the long term, we believe that we can increase the rate for deposits if need be. In the past, when they've been raised by 16 basis points, we've accumulated $300 million in short order. If no new broker is found, we can take a look at a strategic partnership with an overall bank. That's a wrap for me. I would like to pass it on to my colleague, Alex, who's going to talk about the second crisis we may be facing.
Thank you, Maziar. We're moving now to the second crisis, an independent scenario that's placing us in a position where we have to assess a takeover bid from Shoppers Drug Mart. They have an offer for a share exchange, and they're planning to acquire 100% of the shares of Pacific Western Credit Corporation. The decision we're facing is, should we accept or should we reject this offer? The key point here to consider is shareholder value. Our understanding in this case for us focuses on superior return on equity, achieving access to new markets and the ability to grow, and the expected synergies from this transaction. We have looked in this process at a set of decision criteria. Among them is practically the synergies that were a major focus regarding the credit card business. This greatly expedites, as we said, the credit card business and allows for quicker growth for us. We have to remind the board as well that it was one of our key recommendations to pursue this strategy for a higher margin, high spread on the credit cards. It's a lucrative business, and a partnership with the potential acquirer would be very advantageous for us in terms of creating an incentive program, a loyalty, and repeat customers that would practically use this card increasingly and use these points inside the shop, the drugstores on each visit. Superior return on equity is practically going to push PW further. It's going to accelerate the growth. And on the other side, in the situation where we reject this deal, we might have to justify why we are passing on a great opportunity. We did our assessment of the value of the company, and we have to stress that it largely depends on the execution of the growth strategy that the company is currently planning. Key points in here include the success of the receivables purchasing program, which is high margins and high profits, the expansion in Western Canada, as well as the purchases on high margin mortgages. These growth plans would practically impact the value of the equity and influence the overall value of the company, and which practically places the shareholder in a position to assess the premium required differently than otherwise. The market value is, of course, sensitive to the overall credit crunch, which has depressed the overall market value of the companies across the board, especially in the financial industry. A quick assessment of the current situation. The share price is at 3.1 as of today, with a market cap of 42.3. The question is, given this market value, is this reflective of what the company is truly worth? We believe it's not, given the potential for growth that we've identified for the company. But before we move into that, we've assessed possible valuation methods. We focused on the first and the last one, the cash flow to equity. We focused on the present value of expected dividends and the price to equity multiple. Based on the calculation that we've run today for you, you can see that it's a wide range of valuation for the company, highly sensitive to the assumptions made. The midpoint for this valuation is around $78 million, equivalent to $5.72 per share. This compares favorably compared to the current market value of 3.1, which means that the premium required for this purchase to be advantageous for you is considerable. I'll move now on to the next point on the agenda, and I'll leave the floor to my colleague Namita, which will introduce you to the stakeholder considerations.
Thank you very much, Alex. So one thing we noticed about Pacific and Western is that they're very strong on corporate governance. This is something that's important to them. They have a lot of committees on their board, and this is something they take pride in. And so in choosing whether to accept this kind of offer, you not only need to consider the shareholders, but you also need to consider the other key stakeholders. So we've gone through some of the potential stakeholders and what this kind of decision would, how it would impact them. Specifically, your shareholders would receive a premium, so that's a good thing for them. In terms of your employees, they're also going to receive a premium because you currently have an employee stock option available to them, and so they'd be benefiting in that way. But, I mean, obviously, you might be concerned about their long-term welfare, and maybe they'll lose their job if Shoppers Drug Mart takes over. So one thing you could build into your contract is the potential for them to stay on board with the new management team. Other key stakeholders include the deposit brokers and your borrowers, but we believe that they could continue their relationships with Shoppers Drug Mart should it take over Pacific and Western. And mainly, we wanted to take a look at David Taylor, who's the CEO and president. And this is a company that, you know, he's put a lot of his own blood, sweat, and tears, let's say, into. So this kind of offer has an impact on him as well. We do know that there's a clause that if the company is taken over, David will receive at least 2 years full salary. And he's also going to probably be able to enjoy an early retirement and his hobbies, such as aviation. So this generally can be a win-win situation for the key stakeholders as well as the shareholders, and it's something that should be taken into account in making a decision. This brings us to our recommendation, which is overall, considering the current market situation and the financial considerations that Alex mentioned, as well as the key stakeholders and how they'd be affected, the Board of Directors should accept this offer. We're going to provide you with a brief implementation plan for how to go about making this happen. So the first thing to do, specifically because valuation is so important here, is to request an independent valuation. We know that the company isn't reflecting exactly their worth, especially in the current crisis that we're facing. So this would be a benefit to the shareholders and to David and the other key stakeholders. Also, complete all financial and legal due diligence. This is something that's important, especially when you have a feeling for the company and you want to continue the key values. Also, you should develop a post-transaction integration plan, and finally communicate this plan to the key stakeholders.
It's a terrific analysis. I guess the question would be, when you looked at the Shoppers offer, did you also consider who other partners might be? In your first crisis, you cited an affiliation with a bank. Did you do the trade-off between different types of partners, and how did you end up in the consumer partner as the solution?
Yes, we did look at it. One of the things that is important to your company is that you want to keep your costs low, and you're not really interested in having retail banks. The bank that we were considering in the West does have retail banks. And the synergies that were possible with Shoppers Drug Mart, especially when you look at the model that Canadian Tire has of having a bank with the store that works well, we thought it was a really good model, and the trade-off worked better, especially since it didn't go against your strategies and who you are as a business. It was more of a question of a fit than anything else.
Let me also compliment you on your analysis, but also on your courage, because it's a very courageous strategy to tell a board of directors and a group of senior management who spent a good part of the last several years putting their heart and souls into building a company, and I think you're telling them it's time to cut and run. Having said that, your analysis is very good. There's one issue, though, that you did not address, and I just want to explore your thinking on it, and that is the currency with which Shoppers is paying for this takeover is shares of Shoppers. It's not cash, it's shares. So what would your analysis be, and what would your advice to shareholders be about the value of those shares and the ability of those shares to maintain their value?
Yes. We have considered this possibility. The assumptions, the starting point in our analysis was once we arrive at a certain value for the company that we consider fair, we would look at the fair market value of the Shoppers Drug Mart shares at that point, and perhaps over an extended period of time let's say an average over a 30-day period, and take that as the value of the shares at that point in time. Now, of course, those shares may decrease in value over the near term. That would be a risk that we're facing, and we're willing to take that into consideration. It is hard to expect and predict what the market fluctuations would be in the next year or so. However, given that the market context is on the downward side, the number of shares from Shoppers Drug Mart that we would be receiving at that point in time would be higher than normal, and we could only expect the value of the shares to actually increase in the future as opposed to decrease.
If I just may add to your point of us being very, we do this out of humility, and it's basically when we listen to the president and CEO talk to us about the case. The question was asked, how would you feel if you were taken over by another company? And he had mentioned to us that he would be very open to the idea as long as it added value to the company and the synergies were there to ensure that both companies do better. We do, on the other hand, think that Shoppers Drug Mart will do much better once it has the bank under its umbrella, just like Canadian Tire has done much better with the bank underneath it. In fact, today, over 55% of its profits come from the bank and not from their consumer products.
Assuming that you pursue the, and you've recommended to management and board pursuing the Shoppers unsolicited offer, how do you propose that you might introduce an element of competition to that process to perhaps help stimulate that value, whatever it is they're offering? You know for sure that if they're the only ones offering, that they're likely to be offering less than they would be in an otherwise situation. So how do you introduce a bit of competition to that process?
Another option for us would be to, as you mentioned, introduce competition to this proposal. And a possible competition could be Canadian Western Bank, the one that we considered for partnership with the company. And this bank is quite in line with the company's strategy in terms of expanding in the northwest of Canada. And their lineup of products is quite complementary to what Western Pacific has. So in terms of strategic fit, they would be quite a logical offer as if we have a competition for the takeover.
I'd just like to add to that as well. In terms of, the product that Shoppers Drug Mart, I think, is mainly interested in is the Visa card and the retail component of that. So another option we could look at is trying to seek out a retailer who would be interested and to serve as competition on that market. Coincidentally, in our first presentation today, we did talk about finding a drugstore chain to serve as our main retail option. So we could look at other options, which I know David is interested in, such as maybe look at gas stations or cosmetic industries that have people coming to them all the time. And so a Visa card credit option would be a lucrative offer, and then maybe we can create some competition there.
Thank you.
I was interested in your valuation analysis, and I know your time is tight, it wasn't up there long, but your earnings for next year were up significantly from earnings this year. What was, in terms of understanding how a negotiation would go on a sale, what was your thinking in seeing earnings so high in 2009 compared to 2007 and 2008?
The assumptions under which we worked were that our plans for growth would be successful. They are practically related to the acquisition on a monthly basis of $50 million of residential mortgages, low risk, and up to 1% of profit net of expenses. That's one of the lines of expansion. The other ones include pursuing a partnership with Canadian Western Bank in the West to diversify the portfolio, and finally to further emphasize the factoring business, which we have launched in the past, but we have not vigorously pursued so far. So again, that's a lucrative business which, given the current credit crunch, could make the product attractive. So assuming that this growth is materializing for us in the next year, that's practically the support for our estimates.
A question for you. In the sale to Shoppers, you've fundamentally changed the direction in terms of the future growth of the company to consumer lending. In the past, it's, as you say, buying residential mortgages that are government supported or supporting buildings that, again, are public sector buildings. Did you give any thought to the credit capabilities you need and the new skills you need if you're going to go into consumer lending? And maybe that was part of this morning's presentation. But.
Yeah, absolutely. Well, the way we saw it is that the company would continue doing most of the businesses that it's in right now. This would be a way to move a little bit faster. We're thinking that the equity that would come into the bank over this purchase would take care of some of those capital ratios and would allow the company to be more aggressive in going after mortgages. There's no reason not to, given in this context that liquidity is so important, and we were assuming that this crisis didn't involve the second crisis, so we still had a lot of liquidity, and we thought that we'd still be able to go out and buy a lot of mortgages if we had the capital ratios satisfied. So we thought this would be an opportunity to go faster to the point that the CEO had mentioned to us, rather than slower. In terms of the competencies for the credit card business, the CEO had mentioned that you were looking in the U.S. for a processor for the credit card business. We would rely heavily on that processor to take care of that and expand on that as time would go on.
I'm going to add to what Mazier's already mentioned, which is that part of the strategy of Pacific Western is also to keep overhead low and keep it branchless. And we believe that this is still in line with that option, especially if they were to find a processor. So they're keeping their overhead low and they're still utilizing options for faster growth.
Can I go back and ask you a question about the liquidity part of the crisis? You didn't. You're not recommending that the bank try to sell some of its residential mortgage portfolio. You may be aware that the federal government announced about 4 weeks ago that CMHC would have a program to buy mortgages, secured mortgages from banks in order to enable them to increase their liquidity. Did you give any thought to that? And if so, what was your thinking?
If I may. Given that it was part of the strategy to go after mortgages, and we really tried to use a scalpel approach rather than any other instrument. So we looked at our issue and said that in 3 months we really only needed $20 million. We looked at the option of selling off mortgages, and that was definitely on the table. But we wouldn't employ it over the first 3 months because we think we can raise the capital otherwise. Should the need arise, and if we believe that we can increase our rate on the deposit so that we can gather more funds, we definitely could sell more of our mortgages.